On March 15, 2023, in New York City, a critical incident unfolded within the operations of FinTech Innovations, LLC, a company specializing in advanced automated trading platforms. This firm had developed a sophisticated algorithm designed to execute trades at high frequency across multiple financial exchanges. FinTech Innovations had become a cornerstone of the digital trading landscape, boasting users that spanned institutional investors to individual traders. The first signs of trouble emerged at 10:30 a.m. when a misconfiguration in the algorithm's code was introduced during a routine software update. This update was intended to enhance the algorithm's predictive capabilities, but inadvertently introduced a coding flaw, a logic error that failed to properly limit the maximum allowable trade volume in specific market conditions. Though the development team had tested the update extensively, they overlooked the potential for increased trading volume during volatile market situations due to a lack of comprehensive scenario testing. As a result, the algorithm continued to execute trades far beyond its intended capacity, contributing to a significant amplification of trading activities. Within minutes, the flaw began to manifest in the first measurable impact. Trading volumes skyrocketed, with the platform processing over 2 million trades per hour, a staggering increase from the norm of around 250,000 trades. This unprecedented surge in activity created a bottleneck in the system. Exchange servers struggled to keep up with the influx, leading to heightened latencies and failures in processing transactions. Several clients experienced partial outages, resulting in user reports highlighting unauthorized transactions and incorrect trade confirmations. The ripple effect was swift. Other trading platforms reliant on FinTech Innovations algorithms also encountered disruptions. The internal response within FinTech Innovations was marked by confusion. Employees flooded the company's incident communication channels as reports of failures poured in. Initial investigation efforts yielded mixed findings, with some team members erroneously attributing the failures to normal market volatility rather than the newly deployed update. Internal emails circulated, questioning the robustness of the software release processes and identifying potential gaps in oversight. The development team attempted to implement partial fixes, but these measures resulted in further complications, exacerbating the already strained system. External signals quickly followed. Monitoring systems began sending alerts indicating unusual trading patterns, while clients expressed growing frustration through social media and direct contact with FinTech Innovations support. Minor media mentions began to appear, concerned with the unexpected surge in trading volume, though few anticipated the seriousness of the situation. Around midday, as conditions worsened, the broader implications of the flaw became evident. Other marketplaces reported interconnected disruptions as algorithms designed to respond to trade signals from FinTech Innovations reacted dramatically to the volatility. This created an unpredictable feedback loop, causing systems across trading platforms to exhibit erratic behavior. Industry experts began to speculate on the potential for cascading failures across interconnected financial systems, heightening tensions among market participants. In the wake of these developments, FinTech Innovations launched a critical investigation to diagnose the root cause. The engineering team prioritized the flawed update, but faced challenges due to incomplete logging data surrounding the algorithm's operations. As investigations deepened, they discovered that due to a vendor-dependent software component essential to managing trade volume monitoring, A temporary misalignment in settings had rendered those volume checks non-functional. By the early afternoon, confusion among stakeholders escalated. One of the firm's key partner banks reported near-complete operational disruption, with traders unable to execute new orders or manage existing positions. This incident prompted an emergency meeting among executives from both FinTech Innovations and the bank to discuss immediate remedial actions. On the trading floor, institutional investors began to panic. Many rushed to offload positions, fearing further instability. The Dow Jones Industrial Average registered a decline, tangibly reflecting the crisis. By 2 p.m., the index had dropped by 4%, with experts analyzing the potential economic fallout. Institutional clients demanded explanations, increasing the pressure on FinTech Innovations to stabilize operations and provide clarity. Speculation grew about the implications for regulatory compliance and the firm's future viability. Despite these pressures, FinTech Innovations remained optimistic about swiftly rectifying the situation. The team worked diligently to roll back the trading algorithm to a previous stable version while enhancing monitoring controls. Nevertheless, as they sought to contain the issue, the scope of the incident continued to expand, with external impacts looming larger. The evolving crisis attracted attention from regulators, raising questions about the integrity of the trading ecosystem that had, until this incident, been touted as robust. As new alerts continued to flood in, tracking the aftermath of the blown-up trading volumes, both internal teams and external stakeholders braced for a long and complex resolution process. The ramifications of the coding flaw were just beginning to unravel, foreshadowing a series of repercussions that would extend beyond individual platforms and into the very fabric of the global financial system. As the sun set on the day of the incident, the tension and urgency escalated further. By late afternoon, FinTech Innovations executive team convened again, this time including representatives from the regulatory authority, to assess the situation and develop response strategies. An urgent action plan was initiated, focusing on immediate communication with affected clients to provide transparency and to outline proactive measures being taken to regain stability. Communication was swift yet chaotic. Legal teams were also involved to prepare statements while drafting potential PR responses. Stakeholder confidence continued to erode, prompting leading institutions to withdraw from trades facilitated by FinTech Innovations platforms, amplifying the overall market turmoil. The impact rapidly expanded beyond the company itself. Affected financial institutions reported massive financial losses, with estimates suggesting that billions of dollars were wiped off equity prices across participating firms. Minor players who relied on shared market data also faced overwhelming disruptions, leading to temporary closures on some trading platforms that utilized the flawed algorithm. Customers experienced transaction failures or market delays, resulting in reputational damage for multiple FinTech service providers, prompting external scrutiny. By the next morning, thousands of traders had been affected. Wall Street firms were unable to execute trades for hours, while others reported substantial financial discrepancies due to mismanaged orders. Insider reports indicated thousands of traders had incurred losses due to the flawed trading algorithm, with thousands of accounts temporarily frozen as companies sought to mitigate further risk. Additionally, numerous complaints began flooding regulatory bodies, demanding accountability and remediation for losses suffered. As the situation intensified, regulatory authorities escalated their involvement. FinTech Innovations received legal notices outlining investigations into potential operational failures and compliance risks tied to the problematic algorithm. Data forensic teams were deployed to inspect logs, leveraging internal chat logs and tracing transaction anomalies to build a comprehensive understanding of unresolved technical complexities. By the end of the week, unprecedented actions were taken. Affected banks initiated discussions regarding collective legal action against FinTech Innovations, while some industry leaders called for emergency financial stability measures. Law enforcement also entered the scene, securing investigations into the firm's practices surrounding compliance and governance in algorithmic trading. Within 2 weeks, FinTech Innovations found itself at the center of media scrutiny. Journalists uncovered documentation through internal leaks, revealing miscommunication within the team which had led to the failure to rigorously test the latest algorithm updates prior to deployment. Public reports detailed how the vendor's software component had also been flagged in the past for operational discrepancies, adding further weight to criticisms of both internal and external oversight. By the end of the month, the consequences of the algorithm failure continued to unfold. Several executives within FinTech Innovations resigned amidst the growing crisis, citing a lack of confidence in organizational management and fears about potential criminal repercussions. Regulatory investigators subsequently issued subpoenas demanding documentation and insight from various layers of the organization. In light of the continued fallout, FinTech Innovations announced a complete overhaul of their trading algorithms and software development practices. They enacted substantial emergency changes, including migration away from their vendor-dependent components to a proprietary system designed in-house. Simultaneously, enhanced compliance audits were instituted, with third-party assessments initiated to ensure the new framework adhered strictly to regulatory standards. As 2 months passed, some financial institutions filed for bankruptcy, unable to absorb the overwhelming losses and operational disruptions triggered by the incident. Others faced irreversible reputational collapse, culminating in significant market valuations plummeting. Additionally, regulatory bodies introduced stricter monitoring measures aimed at algorithmic trading, obligating firms to increase transparency and accountability regarding software deployment. Ultimately, FinTech Innovations was forced to declare bankruptcy. In October 2023, the company entered a court-sanctioned restructuring process, unable to recover from the cascading financial impacts the coding flaw had triggered. Key executives faced inquiries related to negligence and criminal liability, with some indicating the potential for individual charges against them based on the evidence collected. As a final update on the situation, the technological and financial landscape had forever changed in the wake of these events. The instability in the market led to new regulatory frameworks aiming to minimize the risks posed by similar systems in the future. However, the reputational loss and financial devastation sustained by FinTech Innovations and numerous partners served as clear indications of the fragility that persists within interconnected financial technology ecosystems. Thus, as of November 2023, FinTech Innovations underwent a complete shutdown, concluding the narrative of a company that fell prey to a minor coding flaw with catastrophic consequences.